Listen-only mode.
Yeah. So good morning, everyone. Thank you for joining us for this webinar. My name is Siddharth Srivastava. I head ETF products at Mira Asset, and today I'll be talking about a very new and interesting NFO which we have in fact come out with, and this product, the ETF as well as the fund of fund, will track the Hang Seng Tech Index. The NFO has already opened on 17th of November. For the ETF, the NFO is open till 29th of November, and for the fund of fund, it is open till 1st of December. Now, typically, we have come out with both the options, ETF as well as fund of fund. So, people who prefer to buy and sell ETF units on exchange in a very low denomination. You can buy, let's say, one unit for rupees 20, 25, etc. Right, and you can buy any multiple of that particular quantum. You can do it on the exchange. You can also come directly to the MC, but in multiple of basket side. But you need a demat account for it, right? So those investors can choose ETF, or if you want to use a normal mutual fund route, you want to let's say invest at the day close NAV only, you want to do SIPs, STPs, etc., then fund of fund may be the right way for you to achieve that particular objective. So it's up to the investor, whichever method he or she wants to use. Now, this particular product will provide exposure to the big techs, the tech giants of East, the companies which are listed on Hong Kong Stock Exchange, and I think it will act as a very good diversification opportunity for investors. Typically, whenever we are investing in tech segments, typically we invest in US market, take exposure in Amazon, Apple's, Google's of the world, but this is a portfolio which will provide a different exposure to different set of companies which are doing equally well on the eastern shores, companies which in last 10, 15 years have grown significantly to cater to the domestic audience of China and have made inroads in global markets also. But before that, before I talk about the portfolio, about those set of companies, let me just quickly talk about Chinese economy. We all know how well China has grown in last 30, 40 years. In fact, in late 50s, early 60s, China's per capita GDP was half that of India. But after it opens its economy in 1978, it has grown at an average of 9.2%. It has grown significantly. We don't have historically a record of a very large economy going at such a high and consistent pace through a major part of 30, 40 years. And that is what China has achieved to do. In fact, in the last 10 years, also it has grown at an average rate of around 9%. It has able to increase its GDP from $6.1 trillion in 2010 to $14.7 trillion in 2020. And right now it is the second largest economy of China, of the world. And one very interesting thing to note is how they have approached this journey, right? In 1978, early 80s, they realized that if they have to grow, they probably can leverage their population. They can venture into low-cost manufacturing, heavy industrials, etc., and have this phase of industrialization as well as urbanization, which will act as a key driver of the growth, and they have been able to do that, right? And we have been associating with China with manufacturing, especially on the low cost side, since quite a while. But then, 15 years back, China realized that they have been able to capture the space really well. They are probably one of the most important manufacturing hub globally, but now they need to approach the entire growth in a different manner. And this is what they realized when they were coming out with 11th, 12th, and 13th 5-year plan, which is 15 years back, they realized that if they have to transition from a middle income economy, which they were able to achieve, to a high income economy, compete with developed markets like US, Germany, etc., for their own share in technology, etc., they need to start focusing on innovation, research and development, develop its own set of tech giants on the soft tech side as well as on the hard tech side. And they embarked on this journey where the intent was to develop a tech ecosystem, an ecosystem where the tech companies can be incubated, can be allowed to grow with an intent for again, like they have dominated on the manufacturing side, to dominate on the tech side as well. And this they have been able to achieve significantly, right? While the China's share in world GDP has grown from around 3% in 1990 to 17%, which is more than 6x, around 6x to 17% in 2020. They have also been increasing their share on the tech side. The number of patents filed in 2019 is significantly around 58%. So globally, if 100 patents are filed, 58 patents are filed by Chinese companies, and that is how they have changed their narrative, they've changed their direction. They want to focus now on digital tech, hard tech, to propel their economy in the next phase of development. And this now reflects on several parameters, right? In 11, 12, and 13 5-year plan, their intention was, as I mentioned, to develop these soft tech companies, to increase the internet penetration, to increase the size of tech and digital space contribution in GDP significantly. And in 2005, which was standing, and this was standing at $400 billion, right now it is at $5.7 trillion. So the tech and digital economy contribute around 36% of the entire Chinese GDP, roughly around $5.7 trillion, which is almost two times the size of India's GDP. It was just 14% in 2005. It has grown significantly to 36% in 2019. So China has been able to achieve a very strong growth on the soft tech side. What do you mean by soft tech? Because I'll be talking about soft tech and hard tech a lot. So soft tech are companies which are providing its intangible products and services like e-commerce, social media, mobile payments, etc. When I'm mentioning hard tech, it basically refers to companies which are creating tangible products like 5G, IoT, EVs, semiconductors, etc. So they have managed to create this entire very strong ecosystem of soft tech companies backed by very significant penetration of internet. Right now, for example, there are 989 million internet users in China. Which is more than US and India put together. There are more than around 750 million e-commerce users already. Online payment penetration is 80%. So around 800 million plus people are using online payment. There's mobile gaming users are around 500 million plus. 400 million plus people order food online. So you are talking about a domestic market which is significant in size, and which is what a lot of these soft tech companies cater to. And this penetration has helped these companies grow significantly. For example, Chinese e-commerce market is the world largest e-commerce market at $5 trillion plus, which is significant. Also, now what is happening is, so that is on the soft tech side. Your soft tech companies typically includes Baidu's, Tencent's, Alibaba of the world, also known as BAT, which have done really well, backed by uh, this free hand in a way, which was given by, and which is not now, which I'll talk about later, what regulatory headwinds are there, which this leeway, freedom which was given by China for these companies to grow, to increase the penetration, to bring the people on the internet platform so that people from the urban and rural areas are able to enjoy same set of services. And in a way, there is a rise and access to these services even for the lower income and middle income people, and that is what these soft tech companies have been able to achieve. On the hard tech side now, the Chinese government CPC has started to also focus on the hard tech, especially under the new China initiative. They plan to invest $1 trillion plus on 5G, cloud computing, IoT industry, energy, digitalization, AI, etc. So they now also want to focus on hard tech because they realize that focusing on just soft tech companies is not something which will build the entire ecosystem. They also want to focus on the hard tech, have that momentum even in the semiconductor, EV, 5G, IoT space. And that is why we expect a significant investment and push from the government now on the hard tech side, because soft tech is something which where they have been able to achieve the penetration and scale. They have been able to create domestic champions, the big tech of the East. On the hard tech side, they now want to focus and capture this space also. So going forward, there will be hopefully a significant uh, growth and push from the government on the hard tech space. Now, if we can break this particular portfolio, this particular product on two aspects, right? One is our companies which are catering to soft tech side, which are predominantly soft tech, and one is hard tech. Now, as I've discussed in the latest 14th five-year plan, the Chinese government is pushing hard tech also. They want to increase the R&D expenditure incrementally by 7% every year. They want to focus on core technologies which they have defined as AI, semiconductors, cloud, autonomous, EVs, etc. But which will obviously propel that segment. And on the soft tech side, as I mentioned, the companies have grown significantly. There's a significant market already present for 1 billion internet users. But now these soft tech companies are also facing the music of regulatory headwinds, which a lot of us are aware about. So let's touch base on that and what is happening on the soft tech side. So these soft tech companies were allowed to grow for 15 years, 20 years without any restriction, without much oversight. And now, when they have grown, like in Europe and US, where there are a lot of concerns and regulatory actions, or rather, regulatory, if you can say, there are regulate on how to deal with tech. The discussions are going on. In China, they are also debating on the same thing, on how to reduce the anti-competitive practices, how to improve data security, how to ensure consumer rights, how to ensure vendor rights. And we know the same debates are going on in US and in Europe. In fact, in Europe, there have been multiple instances of fines being levied on Google on anti-competitive practices. There have been issues for Amazon regarding minimum wages or wages being paid to its employee in warehouses, etc. There has been data security issues pertaining to Facebook, etc. Same set of concerns were raised in China, and but the the action, the ferocity, and the speed of action by Chinese regulators surprised the market. There were action taken against companies like Alibaba, like Meituan, where the companies were fined for anti-competitive practices, data security, etc. And this led to a sellout of almost 40% in the shares of these companies. So unlike globally where markets are trading at a premium, these entire set of Hang Seng Tech Index as a whole is down by 40%. a portfolio of very well-known companies, big tech companies, giants of East, has corrected by almost 40% because of these regulatory headwinds and the concerns uh, from the investor on what is the end to this um uh, particular issue which CPC and the regulators are highlighting. Now, now let's look what the China intentions are, and these intentions are for tech companies more or less in line with what is happening in US and in Europe, but with opaqueness. We associate Chinese market with opaqueness, and that is what we are seeing. If you look at 14th five-year plan, they have talked a lot about common prosperity. They want the companies which are doing well to share their wealth with the society, to pay better wages to the employees, to uh, not do practices which are anti-competitive in nature, to improve data security, to manage consumer rights, etc. And with this intent, they have come out with a lot of regulations recently, which is a positive point that they have recently came out with personal information and protection law. They have came out with data security law. In fact, recently they have fined few companies for not disclosing the acquisitions, etc. So while they have raised these issues. They have fined companies, but now it seems that some of these headwinds are dissipating because some clarity has started to come out around the regulation and what they want these companies to do. And these companies also have started adhering to these new regulation, have started falling in line with what the government intention around common prosperity is. So while the adherence may take multiple quarters or years, it seems that most of the headwinds have dissipated. The CPC and regulator also want these companies to cater to these guidelines and regulations and move forward in line with what the vision of the government is around innovation, around R&D, coupled with the common prosperity. So it seems to be a very interesting point to invest in this particular portfolio, which I'll show in next to next slide, that you have a portfolio which consists of hard tech companies, which government is pushing for new innovation around semiconductors, cloud, AI, robotics, etc. And then you have set of soft tech companies which have achieved the scale but have corrected significantly by around 40% recently because of regulatory headwinds. These headwinds seems to be dissipating, so they as a whole products provide a very possibly a very good entry point from an investment point of view. Now, how this portfolio work? It's very straightforward. It captures 30 largest technology companies which are listed on Hong Kong Stock Exchange, which are from Greater China region. From a coverage point of view, it will consist of companies in tech domain belonging to internet, mobile, fintech, cloud, e-commerce, digital, or autonomous segments. So typically, your other companies which are not in these domain will not be captured. It should also meet one of the following criteria, which is it should either have a internet or mobile business platform or R&D expense to sales ratio of more than 5% or YOY revenue growth of more than 10%. Top 30 companies based on market value is selected and a stock cap of 8% is applied. There's also interestingly a fast entry rule for IPOs, that if an IPO is within top 10 from a market cap point of view, it will be included into the index swiftly without waiting for rebalancing, which happens on a quarterly basis. Now let's look at the portfolio. As I mentioned, that this particular portfolio capture the big tech companies of the East, both on the soft tech side as well as on the hard tech side. Hard tech side is something which may potentially benefit you by the push we are seeing from the Chinese government on the development of technologies around the hard tech side, and soft tech is especially something which can benefit you if these companies correct themselves from a point of view that while they have gone down by 40%, they in a way reprice after these headwinds have dissipated to the earlier levels, where which will obviously create wealth, and which will obviously move the index and the NAV higher. So if you look at the portfolio, it consists of Meituan, Tencent, JD, Kuaishou, Sunny Opticals, Alibaba, Xiaomi, JD Health, Haier, Kingdee, Lenovo. It consists of Baidu. It consists of semiconductor companies like Huawei, ASM Technologies, and consists of electric companies involved in electric vehicles like BYD Electronics. So if you look at the portfolio of companies or business segments it is serving, it is not something which is concentrated to just one revenue stream, right? You are having exposure to e-commerce through JD, Alibaba, other companies are having exposure to semiconductor through SMICs, ASM, Pacific Technology, Huawei. You are having exposure towards smartphone companies involved in smartphones, company involved in camera lenses, companies involved in cloud computing, healthcare, IT, 5G, IoT, etc. So unlike IT segment in India, which we typically associate with consultancy, when we invest in US, like we have a product called FANG, there you have companies which are, they don't have just one revenue line, they have multiple business segments. Similarly here, when you're talking about, for example, let's take example of Baidu. It is the search engine of China, but one of the business line is cloud computing, and it is doing phenomenally well, and it has probably taken a first mover in move in the autonomous vehicle segment. So a company which is into search engine taking a first move in autonomous vehicle segment. That is how evolved these companies are, and that is how these companies want to function. They don't want to restrict themselves with one product or services, and they want to obviously be involved in multiple business line, and that is what add to the appeal of a lot of companies like Alibaba, Tencent, Baidu, JD, etc., which are not only, let's say, on e-commerce but also on smart logistics, robotics, cloud, among several others. So this portfolio will provide you exposure to both on the soft tech and the hard tech industries, ranging from online to more heavy electronic spaces like semiconductor, etc. Now, in terms of size, while the index has corrected by 40%, which will one of the reason why some investors will invest. Even after 40% correction, the market cap of all companies put together is around $1.8 trillion, which is 15% still more than the BSE Sensex companies. Revenue is around $463 billion, again more than 15% of BSE Sensex companies. Cash is around $149 billion, just two times the cash held by BSE Sensex companies. R&D at $29 billion exceeds the R&D of all top 500 companies put together. Now, one thing which we'd like to highlight here is that the Chinese market or Hong Kong market has been more volatile historically. It is more volatile and more risky than Indian equity markets, than US markets, etc. And this especially gets highlighted if you look at historical volatility or historical performance. So a person who has higher risk appetite, a person who is able to bear some of these volatility, absorb these volatility, should only invest in this particular portfolio, because, as I mentioned, it is a highly volatile product. So let's look at the performance of this product, right? Because let's see how this has done. So what we have done is we have bifurcated this product into two parts. One is what was happening pre-regulatory issues, when everything was rosy in terms of post-COVID market started to open up, people were going online, spending money, buying services, etc. And what is happening now? Because probably that will just tell you what has been the historical performance of this product in normal course of time, and what has happened after the regulatory headwinds. So If we look at Feb ending data, which is before the regulatory issues started, we are looking at a product which has generated almost 24% returns since inception. Inception is 2015 ending. It outperformed Nifty 50 by almost 13% on a CAGR basis. In last 5 years, it generated 28% compared to 17% by Nifty 50. In 3 years, 23% versus 12%, 12.6% by Nifty 50. So it has outperformed by almost 10% plus on a CAGR basis in 3, 5, and since inception. In 2 years, it has outperformed by 33%, and in 1 year, it outperformed by almost 53%. So a significant outperformance over Nifty 50. But let's look how it has changed after the regulatory headwinds. After it went down by almost 40%, now still since inception it has higher performance, and it possibly offers a better entry point from a valuation point of view, which I'll touch base later. But do keep in mind that Chinese market is volatile and probably has less correlation with Indian markets. If you look at last 5 out of 7 calendar years, Hang Seng Tech Index has outperformed Nifty 50 Index in 2005 by 20%, in 16 by almost 12%, in 17 by almost 13%. In 18 and 21, it has underperformed significantly. As we can see, minus 31% compared to 4.6% of return by Nifty 50. And this year, when Indian markets are up by almost 27%, the Hang Seng is down by 26%. But in 2019, it outperformed almost by 28%. In 2020, it outperformed significantly, gave a return of 84% compared to 16% by Nifty 50. So while it has created more wealth in 5 out of 7 calendar years, it has also had a period of stark underperformance in 18 and 2021. And as I was saying, this is one thing which will probably attract investors is obviously the valuation of Hang Seng Tech. When the global markets are trading at premium, in double digit premium, like India, US, etc., Hang Seng Tech, which captures these tech giants of East, these well-known companies across tech domain, is trading at some 16 PE, which is almost 38% discount to its historical average. It is almost 40% down to its index highs, and that is what makes the product attractive if you're looking from a valuation point of view. But you're looking from a long-term point of view, as I mentioned, that these companies are giants, right? Software companies catering to a significant domestic audience, trying to make inroad in global markets as well, and hard tech companies which are expected to grow because of the push from the Chinese government in spaces like semiconductors, EVs, cloud, AI, robotics, etc. So not only from a valuation point of view, from a long-term point of view, a good set of companies which is providing exposure to Chinese economy. So just to summarize, and also one thing, that index will evolve as the Hong Kong markets will evolve, as more companies get listed, let's say EVs and companies which are involved in soft tech or hard tech segment, and if it caters satisfy the index criteria, it will also get included in this particular portfolio because it's a rule driven approach which a passive product follows. And so this portfolio is also evolved. Now just to conclude, this portfolio is providing exposure to 30 largest tech-centric companies which are listed on Hong Kong Stock Exchange, both on the soft tech and hard tech side, catering to multiple tech themes like e-commerce, social media, cloud, AI, IoT, healthcare, IT, semiconductors, etc. It has outperformed in markets in 5 out of 7 calendar years. It has done it really well. If you look at Feb ending data, almost double-digit outperformance over Indian markets. Having said that, as we have seen historically, Hang Seng Tech comes it with own set of risk. We have seen regulatory headwinds recently. It may it is a more volatile product. So an investor should assess his risk profile and then invest in this product if his risk profile is basically something which can take care of volatility of this product, and his investment objective aligns with the investment objective of this particular fund. ETF, as I mentioned, the NFO has already opened on 17th of November. It has opened for the fund of fund also on 17th of November. ETF closes on 29th of November, and the fund of fund closes on 1st of December. It is up to the investor to choose the right method of investing. If you want to buy and sell on the exchange, the liquidity is provided by our in-house market maker, which is known as Mira Asset Capital Markets. That will be provided all time liquidity around the net asset value. You can buy one unit, multiple units on the exchange, or if you want to use a normal mutual fund route, you can invest through the fund of fund and either do a lump sum investment or choose facilities like SIPs, STPs, etc. So that's it from me. Happy to take any questions on this particular product.
People who have any questions can click on the question mark tab on their screen. Yes, we have the questions.
Yeah, so I can see a couple of questions. One is, does Mira Asset directly invest into Hang Seng Tech Index or through any other fund? So answer is that the ETF, Mira Asset ETF, will be investing in the underlying stocks directly, and the fund of fund will be investing in our ETF itself. So that is the answer to that question. Now, the second question is which I think one question is which, according to you, will be more aggressive investment, FANG Plus or this fund? So we have, for audience, we have a FANG Plus ETF and fund of fund which invests in 10 companies in the tech segment in an equal weighted manner. It captures obviously the FANG companies, which is Facebook, Alphabet, Apple, Netflix, etc. And this, so I think from a volatility point of view and from a risk point of view, the Hang Seng Tech is a more risky product, volatility product, because obviously because of the regulatory headwinds, which while we feel that most of the issues has already happened, it some new issues may crop up. And while we see that the valuations right now are attractive at 16.8 PE based on 12-month trailing earnings. So it looks very attractive from valuation point of view, but still we feel that this may be a risky proposition. So an investor who has high risk appetite should only invest in this particular product. The currency of investment, for the next question is around the currency of investment. So for this particular fund, it will be for the Indian investors, and for all applications, it will be investments will be done directly investor will invest in INR, whereas the fund, because we are buying Hong Kong listed securities, will be buying the securities in Hong Kong dollars. So what will happen is, as Hong Kong dollar will appreciate, and because it's a stronger currency, the chances of appreciation is more. That appreciation will also add on to the investor returns. In case of depreciation, if we see Hong Kong dollar depreciating, that will reduce the returns of this particular fund. So one question is about the return in Hang Seng Tech. So that is a very obviously one cannot speculate about future returns, but you can look at the historical data on how well it has done before the regulatory headwinds, how volatile it is at times, but how well it has performed in 5 out of 7 calendar years compared to Indian markets, and then take a conscious call whether you are okay with the volatility and want to take exposure in tech giants of East in this portfolio because of the valuation opportunities, among others. So expense ratio of this particular fund of fund and probably it should be around, while do check our website because I don't have numbers handy with me right now. For ETF, it should be around 45 basis point, the TER, which is 0.45%. For the fund of fund direct plan, it will be around 65 basis point, including the cost of underlying ETF. And the regular plan will be around 105 basis point, which is 1.05%. So ETF at around 45 basis point, fund of fund direct plan at around 65 basis point, 0.65%, and the regular plan around 1.05%, so 105 basis point. I think the next one is a very good question. Typically not asked, what is the difference between Hang Seng Bees ETF and Hang Seng Tech ETF? I think answer is very straightforward. The difference is what the difference is between, let's say, an S&P 500 or other S&P 500 top 50 versus a Nasdaq 100. That Hang Seng will provide you exposure in sectors like banks, infrastructure companies, utilities, etc. Whereas this will is more tech centric in nature. In fact, tech centric in nature. And if you look at historical performance, this has done significantly well than the Hang Seng index historically. Yeah, so thank you for all those set of questions. I think these were the only questions for this webinar. Back to you, HDFC team, and then thank you for giving me the opportunity to talk about this new NFO which we have came up with. And happy to see. Hopefully, you guys will invest in this particular offering if it aligns with your risk profile.